very high. Yields are responding. What does that mean for EMFX capital flows? Because usually capital starts to move back towards the US. What's your expectation?
Yeah, it's a good point. Well, look, tapering is already beginning, and we know that. Now, where there's a lot of uncertainties when the Fed will first hike rates. Now, if our view is, to put it on the table, our view is that we're much more dovish than the market. We actually think the Fed will only start hiking rates towards the end of 2023, whereas the market, as you mentioned earlier, is pretty much priced for a mid-2022 first rate hike. Now, tapering alongside higher rate clearly will have an impact on capital flows to emerging markets. However, that said, some emerging markets are hiking rates as it is. We had Mexico, for instance, yesterday hiking rates, and a number of other central banks are following suit. For Asia, what we've seen is a big improvement in external positions in recent months. That should give some, at least, shielding towards these capital flow pressures that higher US rates should inflict. But, again, we talked about this earlier, but weakening China growth, and let's not forget as well, Chinese inflation was also very, very high this week. And that will add another downdraft to Asian markets. So I think there's a number of different cross influences on emerging markets. But, some are hiking rates. Many in Asia, central banks are still fairly dovish. But we're not too worried about this region. We think even if the Fed continues to taper, which they will, and hikes rates earlier than we expect, Asian markets and Asian economies should be relatively well shielded from this.
And of course, one aspect of this year we probably didn't expect is oil this high for this long. That has quite a damaging impact on countries such as India. Who else is impacted adversely from this oil price crisis?
Well, that's right. I mean, again, taking a broad view on emerging markets, Asia is probably the worst off region. India is a massive oil importer. China is also a massive oil importer, but at the same time, as a proportion of GDP, you start bringing in other countries. Indonesia, Thailand, for example, are also going to be impacted. So much of the region will face both inflationary pressures from higher oil and energy prices at a time when food prices are already rising as well, but they'll also face pressure on their current account balances due to higher oil. So that will not bode well, obviously, in the next few months, assuming that oil doesn't weaken. If oil continues to rise, I think that will inflict more pain on Asian currencies and potentially also lead to more pressure for higher rates in the region.
Yeah, I certainly don't envy you putting the 22 outlook together. Mittal Kotecha, we'll speak to you next time about your outlook. Thanks for joining us.
Thank you.
And that's it for the big picture for today. Until then, we'll speak again next week. Goodbye.
Did you know that over 80% of trades can occur outside of normal trading hours? Opportunity doesn't wait. Trade more than 70 key US shares 16 hours a day this earnings season. 5-star investing starts with NabTrade, proud sponsor of The Call. Find out more at nabtrade.com.au/The Call.
Good afternoon and welcome to this special edition of The Call. Over the next hour, our two expert guests are going to run the ruler over your stock picks beyond the ASX. So it's all international for the next 60 minutes. It's Friday, the 12th of November. I'm Nadine Blaney. And as always, a very warm welcome to those of you joining us via Twitter and YouTube today. I'm really excited about this one, and it's my pleasure to welcome our two expert guests for the hour to this special episode. In studio with me here is Charlie Aitken from Aitken Investment Management.
Afternoon,
Charlie,
Nadine.
good afternoon to you. And joining us via Skype, David Lane from Ord Minnett. David, top of the morning, I guess afternoon to you there in Brisbane. I'm not going to waste any time here. So you know that we usually start with the stock of the day. But given this is a special edition, I thought instead I want to make sure I get a buy from both of my expert guests. So we've asked our guests to give us one international stock pick that they would buy for the long term. So one for the bottom drawer, maybe for the kids' uni fees, or even to help them with their first home. I don't know, that's personal, but all we want is a company that really stands out as a long-term quality hold with lots of potential upside. And Charlie, because you're here with me in studio, I will start with you.
Oh, well, there we go. Now, there's a lot of pressure on here today. We've got a new format, new ideas, international shares. 98% of the world that isn't Australian equities.
Exactly.
So if you ask me, look, you asked me for one thing that, you know, we own in the fund, I suppose, rather than a buy. If we own it in the fund, we bought it,
Yeah.
right? And it's a big weighting in the fund. Something I think that could do well for people over time, and a business that'll be around in 20 or 30 years' time when people need you know, to see what the result of this idea is. It's actually Nike. It's a very well-known global brand, you know, king of athleisure wear. But I just think it's a wonderful, wonderful business, you know, really backed by a couple of big trends, mainly the trend to athleisure, health and fitness. At the moment, it's seeing a little bit of interruption from supply chains. Obviously, the Port of Los Angeles is a problem for Nike, as it's a problem for everyone. And there's obviously COVID cases in Vietnam where they do quite a lot of manufacturing. So it's been a bit of interrupted at the moment. They maybe don't have the greatest Christmas. But if you're a long-term investor, these are the opportunities you need to seek. So for me, something like Nike, other than being a great brand and great thematics below it, it's actually also a business transformation story. It is cutting out the middleman. It's trying to go direct to you as the customer, cutting out all those sort of small shoe stores and things that have a small range of Nike shoes and many other brands, all trying to go digital and taking much higher margins along the way. I think eventually you'll just order your shoes from Nike.com. They'll know exactly your size. They'll know where you live. They know what you do running or whatever, or Pilates or whatever it is, and they'll try and sell you a T-shirt as well. So for me, Nike is a wonderful, wonderful global business, being slightly interrupted by the issues of today, which is supply chain. But that's one I can see us holding, you know, hopefully in 20 years' time. And if I'm around in 20 years' time, it's probably because I use my Nike shoes to stay fit.
Yeah, good point. And 19 consecutive years of increasing payouts as well. Now, David, I know that you're also on Team Nike, but you have another company that you think is going to be a long-term quality hold. What is it?
Absolutely, yes. Totally agree with what Charlie said about Nike. But yeah, the stock that we like from a longer term perspective is Disney, or Walt Disney Company, ticker code DIS in the US. Obviously, it's been around for a long time, and we think that it will be around for a lot longer. It's a company that's had an ability to transform. It used the pandemic, or the timing of the pandemic, to launch its Disney Plus platform. We have actually seen the shares come down recently in the last couple of days because it disappointed the markets in terms of its subscriber numbers. It only added 2.1 million subscribers in the last quarter, which was disappointing to the Wall Street analysts, but they now have 179 million subscribers on that Disney Plus platform. And the thing about Disney is that it's been able to use that platform to distribute its movies when we're all at home, and it's now transitioning to a hybrid where they'll still release blockbusters in the movies, but then there'll also be pay-per-view and subscription services. And the thing that Disney has done over the years is really build its franchises. It's obviously got the theme parks, which is a bit of a reopening theme at the moment as the world reopens and people will look for activities to do as we head into Christmas and the new year when there's a lot more travel. But it's also added franchises such as Star Wars, Marvel to its original Disney platform. So continues to build out its content and is able to leverage off that content to deliver more services and deliver more content. So we like Disney. For long-term investors, the share price decline in recent weeks is probably a longer-term benefit, and we think that'll be around for a long time.
A buying opportunity, you could say, and it says that it's going to be making moves into the metaverse, which we know is all the rage these days, even though, I don't know. But we're going to move on from that. Thank you for that, guys. We've got Disney as a pick, and we have Nike as a pick as well. Let's get to the companies that have been nominated by you, our viewers. And the first one is Teladoc Health. So the ticker code NYSE is TDOC. It's for Tanya, saying that this was a company that was recommended by Kathy Woods from ARK Invest, of course, at the Sohn Hearts of Mind conference last year. It's climbed to $300, since come back though to $150 since then. So it is telemedicine, virtual healthcare, AI, analytics, all of those very buzzy things. What do you think of Teladoc?
Narrative. Can't justify it on its valuation. Not one for us. I think you've got to be very careful about stocks that saw a giant one-off leap in COVID-related demand. Most of them have come back 30, 40, 50, 60%. No offence to the great lady herself, she owns most of them. I think that there was a huge amount of money went into her stocks and ETFs right at the wrong time, which is unwinding. And I think the other thing about telemedicine is that the barriers to entry are actually quite low. You need capital, you need a little bit of software, you can actually do it, you can enter this business. So it's one that you won't see me owning. I'm very, very cautious. Go back to one step. If Disney came back a little bit further, you may actually see us put in the fund. I agree with David's thesis. It's a reopening play. It's a normalisation play. Whereas telemedicine, a bunch of other things we're going to talk about today, really had a very large one-off bump from COVID. So I think it's time just to be sensible there. I think the valuation doesn't stack up for mine. We can't make the valuation stack up. And so it's one you won't see us owning. But I just think a lot of those one-off COVID winners, they got very, very, very expensively priced, and just might be time to be a bit sensible. Yeah,
we've got one coming up that was a COVID winner in a big way. David, do you agree with that, though? Because I have had many conversations through the past year and a half where people have said, telehealth's time has come. We're never going to be going back to the way we used to visit our doctors, which has benefits, but it also has downside risk as well. What do you think of Teladoc Health? Is it just simply too expensive?
Well, I think it is too expensive. I do agree that I think that the theme will change the way that we get our medicine. The interesting thing that Teladoc has recently done is Primary 360, which is an operation or a business that they're providing to employers in the US. So I think that will be a way for them to increase their market share and to generate some more revenue. But as Charlie said, from a valuation point of view, it's difficult. It's not a company that makes money at the moment. It'd be one that if you are looking at that theme, you'd be putting it in the bottom drawer and hoping in the future it becomes profitable. But at the moment, it is difficult to justify on valuations. So it'd be one that I'd be steering.
And I will, because you're both new guests to the call, we usually sort of have a rule: if you wouldn't buy it today, then we wouldn't call it a buy. It sort of has to stack up at this present point in time. So that's a no from both of you for Teladoc Health. That's what I'll call it.
That's right.
Peloton International. This is for Matthew. Matthew, thanks for writing in. He says, could I please get everyone's opinion on the company? It's taken a big hit lately. Yeah, sure has after its latest update. Will it bounce back? Is it a buy? Its stock crashed after the quarterly update.
Let's be very clear on the call. No. Okay. It's gone from stupidly expensive to expensive. It is a one-off COVID winner. How many people truly want to ride a push bike in their garage? Not me. Now, I may not speak for everyone.
And you pay a monthly subscription fee.
I know. They get all the subscription thing, but they've got a huge amount of inventory they haven't sold. Their margins are collapsing. I think it's still expensive. I'm a definite no on Peloton. I think it's a classic example of a one-off COVID winner. And let's just put COVID in its place. It is possibly a 1 in 200 year event. And you saw many stocks that were benefited from it go up 200, 300, 400%, as if the demand for those businesses was permanent. Well, I don't believe that Peloton's demand is permanent. Mm-hmm. I mean, it's a good business. I mean, it's a good product, but what do you pay for it? Same as like David's saying with Teladoc Health. I mean, yeah, it's interesting business, but remember, in share prices, it's price is what you pay, and value is what you get or don't get. And I think Peloton's an absolute no for me.
David, Peloton for you, because not only is the share price expensive, but the actual equipment is expensive. It's had to lower its prices by $400, but a Peloton bike still costs almost $1,500. So it limits the amount of people that can even get on one in the first place, don't you think? Or am I being too negative?
No, I think it does. You're very, very right. And there are competitors that are coming into that market. And it's definitely a COVID story. Now that we're not confined to our homes, people are getting out, running in the parks, riding on real bikes, on real roads. The thing about Peloton is that they've also tried to diversify into treadmills. They've just recently announced a new weights fitness program. So they're trying to develop new products. They had massive recalls on a number of their treadmills due to medical issues or accidents. So yeah, I think it's one that again, interesting story. I do like getting on the spin bike occasionally, but I wouldn't pay a monthly subscription to do so, and I wouldn't buy the shares for it.
Yeah, right.
I don't think I'm also buying a TV to be told how to lift weights. Not for me either.
All right. Now, this might be for me in terms of what they say about their customer experience. Lemonade for Fiona. Thanks for writing in, Fiona. Lemonade is an online insurer operating primarily in the US, but also in parts of Europe. But it says that it takes 96 seconds to get your insurance, 3 minutes if you make a claim. Like, I hate sorting out my insurance, I will say that. And the prospect of being able to log on, do it quickly, if you're getting a good deal. I mean, David Lane at Ord Minnett, what do you think of Lemonade? Revenue up more than 100% on the year, but again, this is another company that is actually still making a loss.
It is, that's right, yes. It's probably a better story than the others. It's using AI. It is, as you say, making that online insurance purchase easier. They've done that in home insurance and pet insurance. They've actually just announced a potential acquisition called Metro Mile, which is in the auto insurance business. So they're looking at making the customer experience better. The company, as far as the Wall Street analysts are concerned, it's got 3 buys, 4 holds, and 3 sells. So it's not overly loved by the street. Again, it's one that the valuations are hard to justify. If you're looking for insurance exposure in the US, I'd probably go for a business like Berkshire Hathaway that has massive insurance business, is an incumbent in the industry, but then also has exposure to a whole range of other industries, and you're buying effectively a portfolio exposure to the US.
Okay, so I'll call that a bonus by Berkshire Hathaway, but a Lemonade is a no. From David Lane from Ord Minnett. How about you, Charlie? Can you find a little bit of love?
Obviously, David and I spoke last night and coordinated all our answers. Thanks for
They did not,
thanks
for the record.
Thanks for the Berkshire plug. Berkshire's our second biggest investment, and it's a diversified play on insurance, right, with Geico and Berkshire Re, and then they reinvest the float in other businesses. So look, our quasi-insurance play is Berkshire. But is insurance ripe for disruption? Yes, absolutely. It's sloppy, it's time-consuming. You feel like you're ripped off all the time. You feel you're a good driver and you're paying for all the bad drivers. Like, it actually is ripe for disruption. And I've had a little look at Lemonade. When I first got your list yesterday, I assumed it was a soft drink company, so I'm pretty quick learning about this one. But I mean, I do think the industry is ripe for disruption. There's no doubt about this. This seems to be a bit of an industry leader in the new way of online insurance and claims, and anything that makes it easier for customers to actually renew their insurance or claim, and plus also being probably less of a pull, I think is actually interesting. I'm a no because I can't get my head around the valuation. It's another one of those stocks I just can't get my head around the valuation. But is it interesting? I think it's actually quite interesting.
Okay, so we're going to put that on Charlie's watch list.
That's interesting.
Yeah, interesting. All right, so that is lemonade for you, Fiona. Let's get on to number 4 on the list, Moderna. So mRNA, we have talked so much about Moderna through this COVID experience, we know, but Sam's given us a little bit of color. He said, I bought Moderna recently and it has great potential, still in early stages of growth. The share price has declined about 30% in the last week or so. I'd like to accumulate more. What is the panel's opinion on the stock? So Moderna, you can see, and we know that it developed the mRNA vaccine. It's also in a patent dispute with the federal government. The Biden administration is getting a little bit upset over its production levels, and of course, there have been some side effects with the vaccine. It also missed its sales estimates. Charlie, in a COVID pandemic, Pfizer, beat estimates. So has Moderna lost the COVID-19 vaccine?
Possibly. It still played a great role in it, though. We should thank them for all their efforts. I wouldn't be sitting in the studio here without them.
Yeah.
But you can see, obviously, on the chart that the market got very, very excited about vaccines, mRNA technology, and we're just basically seeing an unwind again, like I've said through the program, of COVID-related winners. This is obviously one of the greatest ones. Look, I think there's possibly easier things to own in pharmaceuticals or in biotech to a degree, and I think that, quite frankly, I'm a no on Moderna as well. I know I'm Mr. No here today, but we own things like Thermo Fisher Industries and things like we just think are better. It's more sort of pathology plays and more analytical plays and device plays. And I think Moderna, no offence to it, is a tiny bit of a one-trick pony, and that trick might be just ending.
Now, is that how you see the landscape when it comes to Moderna, David? Or we're talking about mRNA potentially even addressing some cancers. I mean, the actual technology is potentially in its infancy. To Sam's point, he's seen the share price decline. He obviously, I'm going to make the assumption, sorry, it's not obvious. He's made the assumption that it's for real because he wants to accumulate more. Would now be a good time to do that if you believe in the technology, you believe in the company?
I agree with the thesis that in his case that adding to the stock at current levels does make a little bit of sense. I'd probably be a little bit cautious in the next few weeks and maybe see if it settles a little bit lower because of all of those issues that you've said with the FDA and with a number of the press articles that are going around about Moderna. I think it's definitely an interesting company, and it's no doubt had a massive kick through COVID. Prior to COVID, it was effectively a research and development company in biotech. So it's important to make a distinction between a Moderna and Pfizer and AstraZeneca, for example, who are traditionally drug manufacturers. One of the issues that Moderna has had is that it really didn't have any drug manufacturing until 12 months ago. So it's had to ramp all of that up, and it's obviously had some issues with that. So definitely from a long-term point of view, it's an interesting research and development company that gives you exposure to biotech. If it's in your portfolio, I'd only have a reasonably small percentage of your portfolio in the stock. But probably a little bit cautious in the next few weeks. But could look to add it on a little bit more weakness.
Got it. Thank you for that. And I echo your sentiments. I mean, we're very, very impressive that we had all this vaccine
the speed of it was unbelievable.
It's just incredible. And that's one thing I don't think that people actually think about and realize, the miracle of modern
really
medicine.
Is a miracle.
All right, before I get on my soapbox or too high or comfortable there, let's get on to the next company on the list. And it is a more traditional company, let's call it that, Ford. Now, Doug has written in and he said, I've held shares in Ford myself for a while and was stopped out on a correction. Since then, of course, it's been on a rocket. Is it too late to get back in? It's got a new CEO, Jim Farley, and he's undergoing, and it's still going on, this major transformation of the company. I didn't realize this, actually owns about 12% of Rivian, of course, which is listed at a $100 billion market cap. So the share price has dramatically improved under this new CEO. So is it too late to get back in? Look at that chart.
Well, it's hard to work out what part of that chart is driven by the Rivian shareholding an IPO 2 weeks ago, or anticipation of that, and obviously Tesla and everything else that's been in the space going nuts, as we know. Look, Ford to me is interesting. It's had an almighty rally from near bankruptcy to $20, and the Rivian IPO has happened, and so people can see a crystallisation of that. I mean, Rivian Holdings about 12 billion, and Ford's market cap's 20 odd or 30. It's like it's a huge part of it. Personally, I think right now though, in the electronic vehicle space, there is an almighty bubble led by Tesla's share price. Almighty bubble. We all know what's happening. We all know the transition to electric vehicles is happening, but the valuations are ludicrous in my way, and that's not a pun on the way you drive a Tesla car when you press that button. But I just think you need to be sensible here. I think all the other automakers, including Ford, are actually quite interesting. They will come up with electric vehicles. I mean, you saw the other day, part of the re-rating of Ford was actually President Biden driving an F-150 truck, an electric one. And people went, hang on, they've built an F-150 that actually works. So the competition is coming for Tesla, and price competition is coming for Tesla, and new entry levels are coming for Tesla, and Ford could be part of it. So we've got to do a bit more work on some of these sort of companies. They're a bit capital intense for our portfolio, but they could be a better way of playing the electric vehicle revolution, or a more value-orientated way of playing it, than the obvious people like Rivian and Tesla. So I think it's actually quite interesting, but I just wonder how much of it's been driven by the recent IPO.
Okay, so that is not a buy today. It would be something...
something you'd look at, maybe.
Yep.
Yeah.
Okay, now let's get David Lane's view on Ford, because somebody, it's not going to be just Tesla, right? I had a conversation yesterday with a gentleman who said that you need to look at the Volkswagens of the world, because they're going to be doing it, and they've got the production capacity. Is Ford, potentially a dark horse in this race to EV?
Oh, definitely, yes, and we like Ford. We think it's a good portfolio position. As Charlie said, the share price has rallied recently, but we still think that it and some of the other traditional manufacturers are significantly better value than Tesla, but certainly worthwhile having Ford in your portfolio. It's interesting that when we're talking about inflation, inflation is starting to happen in both new cars and used cars right around the world. So cars over the last decade or even 2 decades have actually been falling in prices. So we're now actually entering a period where manufacturers like Ford will actually be able to increase their prices and potentially increase their margins. And as you said, the electronic vehicle theme will be a continuing theme for decades to come, and manufacturers like Ford will be at the forefront of that. Tesla gets all the headlines, but all the manufacturers are going in there, and Ford's our pick on the.
David makes a good point there, right? I mean, the traditional manufacturer fight back's coming here. The competition's coming. Yeah, Tesla's had a first mover advantage, but its product's expensive. It's not for everyone. So look, I think this is going to get interesting. I think that these companies aren't just going to fold over and die and let Tesla sell every electric vehicle. So it's just going to get a bit more interesting from here. And look, I think David's summary is pretty good. Yeah,
David, so just to push the point a little bit, would you buy Ford today?
Well, thankfully we already have it in many of our portfolios, so I probably wouldn't be buying it at today's price, but definitely we anticipate that over the coming weeks and months, as there is discussion about interest rates and inflation, that we could see a little bit of weakness in the markets, and Ford would be a stock that I'd look to add to on weakness.
Add on weakness. It's currently trading at $19.55. Of course, US dollar and currency is something that you do need to account for when you're investing in international shares. That's my PSA for the day. And also, don't forget, this is information only. This is not for your personal circumstances. So you do need to do your own research and get financial advice if needed. Mind the disclaimer at the top and bottom of the show. Listen, we'll let our guests have a bit of a rest while I take you through what we've learned already so far in this special international edition of The Call. I had a feeling you all out there would want a firm buy from our guests, so we did that off the top. Charlie's buy for the long term in international shares is Nike. So innovation, digital advantage, going straight to the consumer. It's doing well, and it will continue to do so for the long time in Charlie's view. Now, David has chosen Disney. So Disney, it's a reopening play. There's plenty to go, behind it in terms of tailwinds, in terms of the theme parks, and it's also got its movie business, and it's got the subscription service that so many of us signed up to during lockdown. And it's still got a ways to go, but he believes he will do it over the long term. So David's got Disney. Now, to the companies that have been nominated by you, and thanks again for writing in. We had a huge response to this program. Teladoc Health. Look, this one was for Tanya. This is an avoid for Charlie based on valuation. It's a business that has very little barriers to entry, even though, it is one of those COVID pandemic thematics that has been emerged. And again, for David, it doesn't make sense on price. It's a valuation company. It's expensive. Peloton International, this is for Matthew. That is a hard no from Charlie. He made that clear right from the beginning. Oh, no. It was, stupidly expensive in his view. It's gone from stupidly expensive to just expensive. So that's a no, Matthew. And again, David points out that there's competitors moving into the space. So even though it's evolving and treadmills and weights and everything else, not only do people want to actually get back on the roads when they're allowed to get out and about, it's that, this is not, again, I guess, a huge moat around this business. Now, Lemonade, Charlie admits that insurance is a business that is absolutely ripe for disruption. However, this company in particular is a no. Says it's interesting, he'll keep an eye on it, but again, valuation. Don't forget, even if you love the business, it's about what you pay for it. And David, for Lemonade, says that it is, again, a valuation call for him. Excuse me, I just need a little sip of water. What he would rather buy to get exposure to the insurance space is something like Berkshire Hathaway, excuse me, which Charlie loves because he holds Berkshire. It's his second biggest holding, is it? Second biggest, yep. Got it. And then fourth on the list was Moderna for Sam. I've just got a tickle. He's bought it, but Charlie says no. He would rather look at some of the pathology plays in the States. Again, it's this unwind of the COVID winners. Excuse me.
It's all good to do.
Yeah, no, I know, that's awful. Okay, he's got his mask out. Moderna. Speaking of COVID-19, not a time to buy now in terms of David Lane's view. It is an R&D company. It got a huge boost from COVID-19, but it is not a traditional manufacturer. So again, not bad if you're looking for some exposure to biotech, but it would be a very small part of your portfolio. I'm back on track. Ford. Ford is interesting for both of my guests. In fact, David would say you do want Ford on your portfolio. He wouldn't buy it today because he'd wait for a pullback. Look, Charlie's interested by it because Tesla's not going to take the whole EV market. So it's an interesting one to him. I think that he would prefer to buy it, though, cheaper. He's going to do a bit more work on that one. So there you go. Those are the companies that we have covered so far. I'm just going to update you quickly on the portfolio. Of course, this is the portfolio that we've been tracking since July 1st of last year, thanks to our partner NabTrade. The stocks that we are talking about today will not be going in. However, we are still tracking the progress of any stocks that get 2 thumbs up today separately. Look, this is the portfolio over the week, up 1%, over the month, 4.5%, roughly speaking. Year to date, so financial year to date, 9.5% higher. Since the fund's inception, though, so that's since July 1st, 2020, we're up 48%. So, of course, it's all ASX stocks and some companies that we've added lately: Rhythm Biosciences, MedAdvisor, 7 West Media, Smart Parking, and Vanguard US Total Market Shares Index ETF. Stocks that we've taken out, though, and this was just yesterday: Southern Cross Media, Magnus Energy, and PWR Holdings. Hub24 also out as well. And if you'd like to take a look in at that portfolio, you can do it at ausbiz.co/portfolio. And we update you every day with how it's tracking.
Grab a beer, grab a glass of wine, because this is where we just gossip.
It has been easy to get this bull market wrong.
Cheers to you.
Have a great weekend, everyone.
The Last Call is brought to you by Australian Vintage Wines. Invest in the home of Australia's premium wine brands.
Welcome back. It's a Friday afternoon. We're doing a special edition of the Call All International Shares. A lot of those companies were US based, but of course it's a big world out there. And Greg, thanks for writing in, Greg. He's asked about ASML Holdings. It's in the semiconductor space. It's actually been called, Charlie, the most important company that people have never heard of.
Yeah, I think that's absolutely right. And I kick myself for not owning this one. You know, I've always thought this is one where you have to admit you've made a mistake. This is one of the most important businesses in the world. It absolutely is. The world can't even operate without their microchips and semis. And it's just a wonderful, wonderful business. But it's always been optically expensive. I mean, it generates a ton of cash. It's highly profitable. It's a great business. It's really well run. It's absolutely vital to the world economy. But I've made the mistake that, you've got to admit your mistakes, of always just thinking it was a bit too expensive, waiting for a pullback. That broadly never happened. If we ever get a pullback in ASML, and it may happen at some stage, if it did, dipped a little bit recently, but that was just on rotation. I think that is an absolutely wonderful business. And, it's got pricing power, it's got huge barriers to entry in terms of how it puts its microchips together.
Yep.
That's really proprietary technology. And I think that is a truly wonderful business. So if you're lucky enough to own it, well done. I wasn't smart enough to buy it at the right price, but it is, in my opinion, you could call it a buy if you want to call it on that list.
Well, that's what I was going to say,
Yeah.
Charlie, because you don't mind paying for quality. I mean, if you believe that the share price is going to continue to
it's
rise,
absolutely.
why wouldn't you buy it today?
Oh, because we only own 20
this is
stocks.
for the fund, yes.
Yeah, competition in the portfolio is what you can't have everything. But I do sort of kick myself for not owning this one. I think it is a truly great business.
Now, I know that you don't own it in the fund. However, I am going to
You can put me
tag
down
that
as a buy. Yeah,
Yeah,
that's fair.
I got one from him, guys.
Yeah, that's a
there you
buy.
go. David, how about you? Look, we know the troubles that we're having with supply chains right now. Those will wane, but it will be a boon for the company in the meantime. But it's up 100% over the past 12 months, to Charlie's point. I mean, is it just simply too expensive to buy?
I think it is at the moment, yeah. So I totally agree with Charlie's view on the stock, and it is a very good business. But the thing that surprised me is the share price has been as strong as it has in a time when they've had all sorts of material shortage and logistics issues. Obviously, not just ASML, but the whole semiconductor industry has been facing those issues. So. Surprised that we haven't seen a little bit of weakness in the share price. If we do see some, I'd be looking at adding it, but at the moment I'd probably be steering clear.
Okay, that's interesting. ASML for you, Greg, that's the call. Let's get to Nvidia because it's in the same space. So it was basically a processing chip for design units, so for the gaming and the professional markets, but it again has evolved. So it's getting into the automotive market and it's getting into mobile computing, which of course is, it is where the semiconductor demand is coming from. So Nvidia, it's a tech stock valued, and here comes the value again, more, fun fact, than JP Morgan, so the mega bank. Would you be buying Nvidia, David? Because we do have, we've mentioned Meta already. Everybody's talking about getting into the metasphere, and you're going to need Nvidia chips for that.
Definitely, yes, absolutely you are. And also we spoke earlier about the EVs. Nvidia chips are used in Tesla vehicles and will be used in a range of other vehicles in the future, no doubt as well. They're used for GPS tracking and so it definitely, the technology is here to stay, and Nvidia is the leader in that space. Again, it's difficult from a valuation point of view to justify their share price, but for a long-term portfolio, I really think it is one of those stocks that you can actually buy for a long-term portfolio, hold them, and in 5 or 10 years' time, you'll be very happy that you've done so.
Okay, so you would buy Nvidia, even on valuation, but you would not buy ASML. Like, is there a reason? Because I know I'll be asked that.
Yeah, well, it is challenging and it's tough. I think that ASML, in the short term, I'd like to see some weakness in their share price as we get through these logistics issues. It's obviously having an impact on Nvidia as well, but I think over the longer term we've seen a little bit of a more of a pullback in Nvidia, and it's again one stock that I'd put in the portfolio in a small caution and hold for the long term.
Thank you. What about you, Charlie?
Yeah, I broadly agree with that, actually. I think, look, it's had a big pullback. It was a big narrative stock, obviously gaming, lockdowns, et cetera. But look, it's been hit hard because of the actual chip shortage. It is a problem. It is right in the middle of the chip shortage. Yeah. So it's had a revenue miss and all that sort of things. But look, I think it's an interesting business. It's got great products. Products are essential, a bit like ASML for daily life as such. But we don't own it at the moment, but I think it's an interesting stock. I think its valuation is more interesting than it was, obviously. Yeah. And I broadly, without just doubling, repeating exactly what David said, I actually agree with his thesis, and I think that it probably is a buy down here. You could have a nibble. Yeah,
good. All right, so we got to buy Nvidia. If we had a fantasy portfolio, that would be one going in.
There's the global fantasy portfolio.
Okay.
Come on.
I think it's going to become a thing. I'm gonna push for that. All right, this one, cheeky. This is for Nick, because he's basically getting two companies in one. But anyways, he has said, which would you buy, Microsoft or Apple? So let's compare the pair.
Well, I can answer that one pretty clearly because we sold out of Apple about a year ago, and we had third biggest holding is Microsoft. I think Microsoft is a truly wonderful, wonderful business. It has long-term potential to compound earnings over time. When you think about your day, yes, you look at your iPhone every day, but the operating systems in most offices and most personal computers now are Microsoft, and they've got pricing power. They just recently put up their prices. If you go back one step, we are in a more inflationary world. So you want businesses that can raise their prices above inflation and grow faster than inflation. Plus, you also want businesses that are lowly geared, don't have to pay more for their debt. Microsoft ticks every box. It's got wonderful management, and it is it's quite amazing to see a $2 trillion company still growing at 20% per annum. It is absolutely amazing with pricing power. And it's something like I think it's 55% of their revenue is just unearned. People just opt to pay for Windows, etc., for the next 6-12 months. So they roughly know what their revenue is going to be. They're doing big buybacks. I love Microsoft, and we don't own Apple because Apple, it's a great business. It's one of the world's great businesses, but it's still a device company. For all the stuff about services, it still gets 65% of its revenue from selling iPhones, and that's fine. But to turn the dial on Apple from a revenue perspective, they need another blockbuster something. And I just can't see what that blockbuster something is. When you're 2.2 trillion market cap, you really, really need to find a new product. Yeah, they can go along and they have more services revenue in the ecosystem. We get all that. But I far prefer Microsoft over Apple at these prices.
$332.
Yep, all-time highs. Yep, still happy to buy Microsoft.
That's a buy.
And we'll just leave Apple alone for a while.
Okay. Maybe an Apple EV would change your mind. I don't know. All right, let's get David Lane from Ord Minette's view on Microsoft v. Apple. Which would you pick?
Well, I hate to agree with everything that Charlie says, but I'd also prefer Microsoft. Although having said that, I don't mind either, and in a diversified portfolio, I'd be quite comfortable owning both Microsoft and Apple.
That's a fair
but Microsoft, as Charlie said, very, very good franchise. We all, well, not everybody, but most people use the products on a daily basis, and it is now a subscription business, so it's just continuing generating that cash flow. Apple is really almost, although we do look at Microsoft and Apple as somewhat competitors, they're really different now, and Apple is almost a luxury goods provider, and they can charge a premium for their product. And again, Apple is also being impacted by the shortage of chips at the moment, and they've already said that their sales of iPhone 13 will be impacted by that. There's delays in getting delivery of their new phone, and they're now semi-reliant on their churn. So there's an average of 3.2 years that we turn over our phones, and that's what they're relying on for the sales of the iPhone 13. So at the moment, if we're comparing the two, I would also lean towards Microsoft at present.
I mean, I think the point about how far Apple can push prices is another good one. Where do you balk at a new iPhone? What price is it? And I don't think they've got the pricing power that Microsoft has. I think Microsoft has better pricing power, and that really attracts us. So look, again, they probably shouldn't be compared that much. One's a device company and one's a software business, but two gigantic companies. But they're still both great businesses.
But this is the thing.
We're mucking around semantics a little bit.
It comes up a lot, though. We have the propensity to buy names overseas that we know that we use.
There's no problem with that. That's worked well. That has worked well. if you'd simply bought the businesses that you use in daily life in Australia in a global portfolio, you probably killed it. If you think about it, like you don't actually have to overcomplicate this that much. You would have killed it.
Yeah. All right. So that's the verdict on Microsoft v. Apple, and it is clearly in Microsoft's favor. Now we get to Roblox. So this is RBLX for Stuart. He's been teaching his 10-year-old daughter about the share market, and she suggested, I love this, that he should buy shares in Roblox. Apparently they've been around since 2006. Yep. All her mates play it, give each other Roblox money. I'm sure I'm telling many parents out there what they already know. So they can actually use currency within this ecosystem. You can actually trade it out for real currency. Stuart says, is it a possible 10-bagger? I'm going to start with you on this one, David Lane. It's a video game developer, so you're in that ecosystem and you can create characters. Its net loss widened, even as it saw a lot of use during the pandemic. But the interesting thing, the company says they haven't seen that demand waning when kids have gone back to school. What do you think of it?
Yeah, I have to admit that with my kids now a lot older, it wasn't a product that I was aware of. So I've done a little bit of research on it, and if you believe Mark Zuckerberg and the metaverse, companies like Roblox have been ahead of the curve because they've really created their own metaverse, and certainly an interesting business, interesting company. Again, very difficult to justify purchasing it on any form of fundamentals. As you said, it's a loss-making business. But it could well be one of those stocks that in 10 years' time, it could well be a 10-bagger, but it may also be something that in 10 years' time you don't have any money. So it would be very, very speculative. But yeah, an interesting story nonetheless.
So is it a concern to you, David, that these things can be faddy? Like it's a fad amongst all the kids right now and that can change? Is that part of it?
Oh, definitely. Absolutely, they can be. And yeah, certainly kids can change their allegiances very, very quickly. It is the sort of company that could become a takeover target for somebody like Facebook or Meta, as it's now called. But yeah, buying a stock like that for those sorts of reasons is, again, highly speculative. So it's, probably an interesting story, but one that I'd prefer to read rather than invest in.
Well, yeah, that's my question to Charlie. I mean, do you?
Well, look, I got to admit, I got to fess up to the viewers that this whole video gaming thing just passed me by. I'm too old. I played cricket. I don't understand it really. I mean, the younger guys in the team have their heads around these things. Roblox, 62 billion market cap US. Okay, this is no small company, right? This is a big company now. We have an investment in Japan in Nintendo, an established video game player with an established network that's moving more to subscription and actually opening theme parks and doing a bit of a Disney, but in a Nintendo version, and it's cheap. And we can see the cash flow, we can see the dividends, etc. So we play this whole video gaming thing through tangibility and things we know. I have literally no idea if Roblox could be a 10-bagger or, as David says, a zero. But I would say one thing, often when your children tell you something is good, it actually is worth buying 1% of it or something.
Yeah.
Just 1% of it, because we don't know. I'm 48, I don't know a thing about this thing, right?
Yeah.
It's passed me by. So it is not actually ridiculous to have a small toe in something your children think is interesting. Would have worked in Instagram, Facebook, all these sort of things,
I'm not giving financial advice,
but
wouldn't that be a great Christmas present for the 9-year-old?
Maybe not giving her Roblox,
just give her a few shares in Roblox.
Well, she might be better off in Roblox shares than Roblox currency, put it that way, right?
Look, are you buying this whole
I can't
Meta?
say buy.
No.
I'm just not. That's way too early for me. We won't know for about 15, 20 years if Zuckerberg's right on that. He'll either get it absolutely right or waste $50 billion. I don't know is the answer. I think there's businesses that could benefit from it. Like that's one of the reasons we own Nintendo and things like that. But look, I couldn't call myself a world expert on the metaverse. I don't think anyone can really.
No, we can't even call it Meta. We keep saying Facebook. David, have you changed your thinking from Facebook to Meta yet? Are you more in tune than us?
No, not quite. No, I don't really, can't profess to understand it greatly either. But yeah, certainly an area that is evolving and has become, very interesting. But yeah, not from an investment point of view.
Okay, Roblox is too risky for both of my expert guests. And that brings us to lucky last, which is Open Door Technologies. The ticker code is OPEN, Open. This is for Chris. Now, this is an area of the market that's got quite a lot of headlines generated around it lately because Zillow was in that business. It basically using AI and algorithms to buy homes and buying off real people, and then the idea is that they sell them for more. Well, Zillow fell into a whole lot of trouble, but reportedly, Charlie, Open Door Technologies is doing it better. In fact, this is a company, one of the few on the list today, that is making money. So it posted EBITDA of 35 million in the third quarter in a tough market.
Yeah, I mean, it's hard not to get tarnished by the Zillow stick. I mean, letting the computer do what it likes and burning 500 million or $1 billion, God knows what the loss is going to be. When you were a great real estate portal like REA or Domain, that's what Zillow was, and then they ventured off into capital-intensive flipping houses, which works in a bull market for a while until you pay the wrong entry price. And
apparently they were paying the wrong entry prices and their algorithms, while Open Door pulled back in certain markets,
Correct.
Zillow was still going
Zillow
full speed ahead.
just getting hit and hit. Now they own 17,000 houses and they've got to get rid of them, right? Yeah. And they've got borrowings against it. It's a mess, right? And it probably affects Zillow's brand badly for the foreseeable future, even as just a portal for real estate, where people go, "What's his estimate?" That's that thing where you blew it up yourself. So what's your estimate worth? Look, Open Door is interesting. It could be a beneficiary of all this. Actually, there will be a winner in this sort of. You get an online quote for your house and you sell it. I mean, let's go back a step. And no offence to the real estate agents that are watching. Real estate is ripe for disruption. Everyone knows it, right? It's antiquated. It's opaque. You don't even know who's really a bid or who's not. It's very antiquated the way real estate trades, particularly in America. So I think the sector is ripe for disruption. Open Door might be the disruptor. Might be. I wouldn't say buy it because I can't again get a total head around the valuation. But I think Zillow blowing up may well be good for Open Door. And maybe they're a better business, maybe they're more on top of what's happening. But this idea that every person in America every real estate agent gets 5 or 6%, both sides of the transaction, it's just, honestly, it seems 100 years ago. And there's just no transparency as well. So, look, I think it's an interesting business, but I think maybe Zillow blowing up is providing opportunity.
There you go, Chris. That's Charlie Aitken's view on Open Door Technologies. David Lane from Ord Minnett, what do you think about Open Door?
I wish I bought it earlier in the week because it's really rallied. I think it was up about 15.5% last night. So they actually came out with their results, which were their revenue was up significantly higher. Short term it's been a beneficiary. It's taking advantage of the very, very strong housing market that we have globally, not just in Australia. So in the short term, while the housing sector continues to run, it's obviously proven that at the moment it's making money. The issue with a company like Open Door is I wouldn't want to be holding it when the housing market starts to turn, because if they end up with a portfolio of houses that they can't sell, or the value of the prices, value of the houses is falling significantly, well then that's when you see a stock like Open Door fall dramatically. So if you're in it, I'd be watching the housing sector very, very closely.
Do you, Charlie, in your fund have any exposure to the housing narrative in the United States?
No, indirectly through Berkshire, which has businesses that are leveraged to housing. But no, look, I think that's all very frothy now. I think all housing is very frothy. I think the interest rate cycle's bottomed. I think that only one way for interest rates to go from here is up. So probably a time to be broadly sensible in housing activity. It always ends in a big crescendo, and then someone blows up. And Zillow just blew up, right? So how much of the US housing price strength was actually Zillow's algorithm going crazy? You don't know, and feeding off into other transactions. So I think broadly it's a time to be sensible in all housing globally and housing-related players, because everyone's a property developer at the moment. Everyone's down at Bunnings painting their fence, doing what they want. So. And the interest rate cycle's changing, so I just think it's time to be a little sensible there. And
if that interest rate cycle is changing, Charlie, is that also a reason to be cautious on some of these high growth companies that did dominate today? I
mean, if you look, forgetting short-term interest rates, really about long-term interest rates and the discount rates and whether they start moving, because I do think there's a bit more permanency to some of these inflationary pressures, particularly energy and wages. I'm not so worried about ports and logistics and other things, or semiconductors. They'll probably fix themselves, but wages are going up. Skilled labour wages are going up. And energy, as we transform to a more renewable energy world, no one's invested in oil. There's no new oil supply. So as that transition takes place, we might have to be used to much higher oil and gas prices for the foreseeable future. So I think that's possibly going to drive inflation expectations and possibly see bonds react. So you want to be very careful if you paid for cash flows 20 years away and the discount rate changes. And that's when you'll lose 40, 50% of your equity value. So I think it requires very close watching. And look, there will be winners out of this, but out of the dot-com boom, there wasn't 20 Amazons. There was one. Not every single thing that's innovation will be a great investment, particularly as interest rates rise a little bit.
Yeah, David, that's a good point. Innovation versus investment, is that key to you when you're thinking about some of these really exciting companies doing really interesting things? Sometimes things that you personally don't know an incredible amount about, and that's not a slight on you. It's just the reality of it, right?
Absolutely, that's definitely the case. That there are lots of innovations that will be very, very successful. Many of which we don't know about at the moment. But over the longer term, as Charlie said, cash is king, and you really want to be looking for those companies that have the ability to back their innovation and have a balance sheet to be able to do so. Many of the stocks that we've looked at today, unfortunately, are very difficult to justify on valuations. Definitely, when we're looking at the bigger picture, interest rates and inflation are top of mind at the moment, and there's some of the things that we're looking at and being cautious about. And I think it's probably important to look at, really, the last 2 years have been a massive aberration in markets. We've seen the big COVID crash, and then we've seen the massive recovery out of it. The next 12 months is not going to be like that. We're going to be coming back to a more normal period, and a period where companies are battling with supply issues, with inflation, with interest rates. So investors need to be a little bit more cautious going into 2022.
I think the other thing to remember, right, let's go back to Peloton for an example. It's the classic example of COVID and interest rates, right? Massive pull forward in demand, right? Plus massive collapse in discount rates equals $400 share price. Discount rates start rising a little bit, demand collapses, share price loses 50%, still looks expensive. So that to me was as David said, I honestly think it was a 1 in 200 year period where if you had the right stock with the right narrative and the right sales growth and the discount rate collapsed, even if it was unprofitable, the share price went bananas. I just think it's a time to be selective. Right? We don't need to own all these things. Because something was once wildly overvalued doesn't mean it's cheap because it's come back 50%. Doesn't mean that at all. Eventually, the market weighs you on the cash that you generate. And some of these things will never generate the cash to justify their current market caps.
Gentlemen, we've reached the end of this hour. So I'm just going to summarize what we learned in the past half hour or so. ASML. Charlie got this one wrong. He wishes that he bought it up, prior to today. He does think that for a long-term hold, because it has that pricing power that he really likes, it is a buy. ASML is still a bit too expensive for David. He would buy on weakness, but what he would buy in that semiconductor space is Nvidia. So Nvidia is a buy. It's a long-term buy and hold because it's used in Teslas, because it's used in all of those sort of themes that will continue to take hold, those mega trends. It is still, a bit expensive, but it's a buy. And it's also a buy for Charlie as well. Yes, it's expensive, but it is a long-term hold. That theme of needing these semis is not going away anywhere. Microsoft v. Apple. So Microsoft wins for both of my expert guests. In fact, Charlie has sold out of Apple. It's a device maker in his view. He's not saying it's a bad company. It's just that's not what he would be buying. He would even buy Microsoft at these prices because it will continue to compound its earnings over time. Again, it's got that pricing power. Again, David doesn't mind either. He's not saying Apple's a bad company. He calls it a luxury goods maker, which is interesting. But he would prefer Microsoft and, again, adding it to the portfolio. Roblox for Stuart. Apologies, Stuart, but it's just very specky, like the narrative. Charlie says your daughter could very, very well be onto something. But again, $62 billion market cap. He's nominated Nintendo as something that he's comfortably invested in that space. Again, David says it's just very, very specky, hard to get his head around the fundamentals. And then it brings us to Open Door Technology. So this is a no from from Charlie. It's just ripe for disruption, that whole real estate industry. This one is interesting, but it's not a buy today. Again, think about valuation. He'll be watching it though, and keeping an eye on that one. It's a hold if you have it for David Lane, but again, worry about the housing market. It is a cyclical business, so you do need to be very careful in those names. So David Lane from Ord Minnett, thank you so much for joining us. It's wonderful
Appreciate
to have
it.
you joining us. That was a bit of fun. Have a good Friday.
It was.
And Charlie
Thank you very
Aitken,
much.
thank you for joining us in studio from Aitken Funds Management. And look, you guys got along really well. I hope we can do this again in the future
Oh,
sometime.
yeah, I liked working with David. He was good. Thanks,
All
David.
right, agreed with everything you say, and vice versa. Now, the call is where you need to email. The call at ausbiz.com.au if you'd like us to cover a stock for you on this program. You can tweet to us at ausbiztv. And don't forget, you can check out that fantasy NAB trade portfolio, the call portfolio at ausbiz.co/portfolio. Have a really good afternoon. Don't go anywhere. Gemma Dale from NAB Trade will tell us what's been moving on the platform this week.